Are you looking to build the perfect portfolio that balances growth, stability, and income? With thousands of ETFs out there, it can be overwhelming to choose the right ones. But don't worry, I've done the research for you. In today's video, we're breaking down the top 4 ETFs you should consider for long-term wealth building. These ETFs give you the exposure to the biggest companies, the highest growth sectors, and the best dividend opportunities, all while keeping your costs low. Stick around until the end because I'll reveal the ideal way to balance these ETFs in your portfolio for maximum returns. Before we dive in, please support our channel by clicking the subscribe button below for more valuable content. Let's dive right in. ETF number 1, VOO, Vanguard S&P 500 ETF. First up, we have VOO, the Vanguard S&P 500 ETF. If you're looking for a core holding in your portfolio, this is it. VOO tracks the S&P 500, which means you're investing in the 500 largest companies in the US. This ETF provides instant diversification, covering every major sector, including technology, healthcare, and consumer goods. Here's why VOO is a must-have for your portfolio. Proven performance. Historically, the S&P 500 has averaged around 10% annual returns over the long term. Low expense ratio. VOO has an incredibly low expense ratio of 0.03%, meaning you keep more of your money working for you. Strong economic representation. The S&P 500 represents about 80% of the total US stock market value, making VOO an excellent barometer of the economy. Historically resilient. While short-term volatility happens, the S&P 500 has consistently recovered from market downturns and continues to reach new highs over time. Top 10 holdings for VOO include the following great companies: Apple, Microsoft, Amazon, Nvidia, Alphabet, Google Class A and C, Berkshire Hathaway, Meta, Tesla, United Health Group, and ExxonMobil. VOO is perfect for investors who want a hands-off approach with strong, steady growth over time. ETF number 2, QQQ, Invesco QQQ ETF. If you're looking for exposure to high-growth technology stocks, QQQ is a powerhouse. This ETF tracks the Nasdaq 100, which consists of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. That means you're getting massive exposure to cutting-edge tech firms that are shaping the future. Why invest in QQQ? Tech-heavy growth. Over 50% of this ETF is allocated to the technology sector. Historical outperformance. Over the past decade, QQQ has consistently outperformed the S&P 500, averaging higher annual returns. Expense ratio. A reasonable 0.20% for an actively rebalanced high-growth ETF. Innovation and disruption. The Nasdaq 100 is packed with companies at the forefront of AI, cloud computing, e-commerce, and semiconductors. Global influence. Many of these tech giants dominate international markets, making QQQ a great way to invest in global innovation. Top 10 holdings for QQQ include the following great companies: Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, Alphabet, Google Class A and C, Broadcom, and Costco. QQQ is great for investors who want to capitalize on the rapid expansion of technology and innovation. ETF number 3, VTI, Vanguard Total Stock Market ETF. Next we have VTI, the Vanguard Total Stock Market ETF. This ETF is a beast because it gives you exposure to the entire US stock market, not just the S&P 500, but also mid-cap and small-cap companies. Here's why VTI is a solid pick. Broad diversification. VTI holds over 3,800 stocks, meaning you're invested in companies of all sizes. Lower volatility. Because it includes smaller companies, it spreads risk across the entire market. Expense ratio, one of the lowest in the industry at 0.03%. Captures market growth. Since it includes small and mid-cap stocks, VTI allows you to benefit from the growth of up-and-coming companies alongside the big players. Less concentration risk. While VOO focuses on large caps, VTI diversifies across the entire stock market, reducing dependence on just the biggest corporations. Top 10 holdings for VTI include the following great companies: Apple, Microsoft, Amazon, Nvidia, Alphabet, Google Class A and C, Berkshire Hathaway, Meta, Tesla, United Health Group, and ExxonMobil. If you want an ETF that covers every corner of the US market, VTI is the perfect choice. ETF number 4, VYM, Vanguard High Dividend Yield ETF. Last but not least, we have the VYM, the Vanguard High Dividend Yield ETF. This one is for investors who want steady income through dividends while still enjoying long-term growth. Here's why VYM is a great addition. Strong dividend focus. This ETF prioritizes companies with a strong history of paying dividends. Great for passive income. It currently offers a dividend yield of around 3%, making it a solid choice for income investors. Low expense ratio, just 0.06%, ensuring you maximize your dividend returns. Stability in market downturns. Dividend-paying stocks tend to be less volatile than high-growth stocks, offering more resilience during market downturns. Compounding effect. Reinvesting dividends can significantly accelerate wealth building over time, making VYM a fantastic choice for long-term investors. Top 10 holdings for VYM include the following great companies: Johnson & Johnson, ExxonMobil, JP Morgan Chase, Procter & Gamble, Chevron, Home Depot, Merck, Pfizer, AbbVie, and PepsiCo. VYM is ideal for anyone looking to balance growth with a steady stream of passive income. Now that we've covered the top 4 ETFs, how do you combine them for the perfect portfolio? Here's a simple strategy. If you want a balanced mix, 40% VOO, 30% QQQ, 20% VTI, 10% VYM. If you want more growth, 50% QQQ, 30% VOO, 15% VTI, and 5% VYM. If you want more dividends, 50% VYM, 30% VOO, 15% VTI, and 5% QQQ. This way you can tailor your investment based on your financial goals. And there you have it. These 4 ETFs, VOO, QQQ, VTI, and VYM, create a powerful, diversified portfolio that can help you build long-term wealth while keeping costs low. Whether you're focused on growth, stability, or passive income, these ETFs have you covered. Which one of these ETFs is your favorite? Let me know in the comments below, and if you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss out on valuable investing insights. Thanks for watching, and I'll see you in the next one.